Welcome to Straight Talk Tuesday. Today is Tuesday, November 10th, and we're looking at understanding employee benefits as part of our financial wellness series. I'm Brent Bowers, a retirement plan advisor at Retirement Plans Inc., and this presentation has been put together with Rich Myers, a retirement plan advisor at Retirement Plans Inc. Today we'll be looking at retirement plan basics, health plan basics, tuition reimbursement, and term life insurance, all as a part of potential employer benefits available to you. Today's presentation is for informational purposes only and should not be construed as legal or tax advice. Please consult with your plan advisor and administrator to find out if this may be appropriate for your circumstances. Let's jump right in. Let's look at retirement plans. When looking at retirement plans, the first thing we'll want to look at is you meeting your eligibility requirements within the plan. This will vary depending on your employer, but in most cases, this is no more than a year of service or a certain number of hours provided to the company. But once you are eligible, the benefits that you'll receive are tax-free growth in the account. So any contributions will grow tax-free within the retirement account, whether this is a 401k, a 403b, or a simple IRA, which are the most common types of accounts. You can reduce your taxable income by making pre-tax contributions, which means that you don't pay tax today, but it is in your account and grows up and through retirement. And when you withdraw it, you will pay taxes at that time. Another benefit may be a Roth option if available to you. These are available in a 401k or 403b potentially. They are not available in a simple IRA, and they're the exact opposite of pre-tax. A Roth option, you pay tax today, it grows tax-free, and when you withdraw it in retirement, you pay no taxes. Probably one of the biggest benefits that's potentially there for you is an employer match. A simple IRA mandates that there is a matching component to that type of plan from your employer. A 401k or 403b plan does not require matching, but in many cases we find that employers are matching at some level. So taking advantage of that full match is basically putting money in your pocket from your employer for retirement. And lastly, our catch-up provisions for those that are 50 or older can increase the contribution they make annually to try and catch up or save more for retirement compared to the normal annual limits. What are the risks of a retirement plan? In most cases, the one risk would be limited access to your money. So you would need to have a qualifying event in any one of the three defined contribution retirement plans I've talked about to access the money. And if you want to withdraw money prior to being 59 and a half, you would pay a 10% penalty for that distribution on top of being taxed if it's a pre-taxed account. So those are maybe the risks that you could be looking at if you're entertaining putting money into a retirement plan. However, there's other ways to access your money that may avoid the penalty if it is before that age, which would be such as a loan or hardship distribution. In some cases may have the penalty waived. It all depends on your plan and your plan document, which is something that your employer can provide to you. Lastly, annual contribution limits for these type of plans range from $13,500 to $19,500. The simple IRA being on the lower end, the 401k and 403b on the higher end. And these are much higher though than an individual retirement plan that you could open on your own. So that's another benefit of a retirement plan through your employer. Next, let's look at healthcare basics. So first things here is we'll look at some terms when it comes to your healthcare plans that you likely would run into. One being a deductible. So this is the amount that you would pay out of pocket for medical expenses and services prior to your healthcare coverage kicking in. So if you have a $2,000 deductible, you would end up paying $2,000 out of pocket before your healthcare coverage would begin to start covering some of those medical expenses. Next thing that we'll talk about is copay. A copay is basically a flat fee that you pay each time you go to your doctor or fill a prescription. In some cases, this could go towards your deductible, but not all cases. Coinsurance is the portion of medical costs that you are liable for after your deductible is met. So once your deductible is met, your healthcare coverage begins to contribute or cover some of those expenses. However, you may still be liable for coinsurance if that's part of your plan, in which you would pay a portion of those expenses. Out-of-pocket maximum means that's the maximum amount of money that you could pay out of pocket for covered medical expenses. So once you've reached that out-of-pocket maximum, let's say it's $5,000, you would no longer owe anything out of pocket for medical expenses that are covered by your plan. Your plan would be liable for all those expenses above and beyond that out-of-pocket maximum. So that would include money for deductible, copay, or coinsurance. And lastly, premium. This is probably the most basic. This is the amount that you pay for your health insurance that gets pulled out of your paycheck to cover the premium. Now, thing to mention here is most states require that your employer cover at least 50% of the premium for your health insurance. That takes us into a couple other options that may be available to you depending on your health plan. So the first one that we'll talk about is called an HSA plan, or health savings account. A couple of requirements here is you have to be enrolled in a high deductible healthcare plan, so an HDHP plan, and the HSA must be used for qualified healthcare expenses. The benefits, though, of having an HSA are they're portable. So that means that if you move jobs, you're able to keep them as long as you have an HDHP plan. They're tax-free growthing accounts. So similar to an investment account or a 401k account, you can invest money in your HSA, and as it grows, it'll grow tax-free. It also, any contribution made to your HSA is on a pre-tax basis, so you're reducing your taxable income, and unused amounts from a previous year will roll into the next year. So that's a nice benefit to have. Another benefit, there are withdrawals allowed, but there is a 10% penalty if you're under 59.5, similar to a retirement plan. And this can be used in retirement. So one thing that HSAs have been designed to do is help cover some of the medical costs that you may incur as you age. We typically see that people's medical costs rise as they begin to age or get into their retirement years. So this is another vehicle along with your retirement plan that can be utilized to cover some of those medical expenses. The annual contribution limits for 2020 in an HSA are $3,550 for an individual or $7,100 for the family. The nice thing too is a contribution rate that you're putting into your HSA on a per paycheck basis can change during the year. Next, let's talk about a healthcare flexible spending account, also called an FSA. A requirement similar to an HSA here is it must be used for qualified healthcare expenses. The benefit of doing so, though, is that you're reducing your taxable income, just like you would be with an HSA. The risk with an FSA that you may not see with an HSA is that the contributions that you make to your FSA must be used in the calendar year or you lose it. Now, there's two exceptions to that. One, there is what's called a rollover provision that may be available in the FSA your employer provides that would allow you to roll up to $500, which is the IRS limit, into the next year, or an extension period of up to 2 months where you could utilize those funds that were not used by the end of the calendar year for 2 months into the next year. But once if those two don't exist, or once they've expired, you lose whatever is available in your account that's not been used. Also, if you were to change jobs, you forfeit your ability to participate, and your balance within the FSA would be forfeited as well. A lot of times when these programs are set up, though, there is a window for you to use it once a change of jobs has happened, although that's not necessarily required. So if you were to change jobs or to be let go, you could potentially have to forfeit the balance remaining in the FSA account at that point in time. And then lastly, withdrawals are not permitted. So once you make a contribution into this account, you must use it for those qualified healthcare expenses. You cannot withdraw it from the account. Now let's look at some other benefits that may be available to you from your employer. So the first thing here that we're seeing kind of expanding in the workplace as a benefit that's being provided is tuition assistance or student loan repayment. So if you're somebody that's looking to continue your education, your employer may provide some type of tuition reimbursement. So it might be worth exploring if that's an option to you. If it is, it's very advantageous to utilize that in order to further your education while having some of that tuition expense, if not all of it, covered by your current employer. And then secondly, if you have student loans that you're currently working to pay back, more and more employers are providing student loan repayment assistance, depending on your current employment status with the company and what your student loans that you have are. So those are two things that if you're not sure of, you should maybe ask the question to whoever your HR representative is for your company, and they can provide you more information on those if they're available to you. And then lastly here, additional life insurance. So when we talk about wanting to protect your family or your assets if something were to happen to you, unfortunately, adding term life insurance through your employer is probably one of the most cost effective in almost all cases that we see as far as getting additional life insurance. Looking for coverage on an individual policy is typically going to be higher cost to you. So that may be a really good way for you to get more coverage to protect your family and your assets if something were to unfortunately happen to you. So that's going to wrap us up for today. I know we covered a lot. Hopefully this is timely information, as open enrollment, I think, is probably in its peak at this point in the year. If you have questions about any of this or your retirement plan, feel free to reach out to Rich Myers or myself. Would love to be able to assist you if we can. Our contact information is here. If not, I'll catch you next time on our Straight Talk Tuesday. Have a great rest of your week.